please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to our earnings special Quarter Se Quarter Tak. I'm Lata Venkatesh, with me Surabhi Upadhyay.
Hi Lata, absolutely. You spelled out, I think, the theme of Quarter Se Quarter Tak for this quarter.
Absolutely.
So here are some of the key questions that we are putting forward for you. The first question we are asking on the show today is, will the Nifty see double-digit earnings growth in Q2, or will demonetization and GST continue to play spoilsport? Will they continue to haunt the numbers in the second quarter? Third, will Nifty earnings estimate for FY18 and FY19 be lowered even more? And finally, which sectors will lead and which sectors will act as key drags on corporate earnings this time around?
And joining us now to answer all those questions and more over the next 1 hour are Sanjeev Bhasin, Executive VP, Markets and Corporate Affairs at IIFL, Dhananjay Sinha, Head Institutional Research at MK Global Financial Services, and Anish Damania, CEO and Head Institutional Equities at IDFC Securities.
Well, let's straight away get to Varinder Bansal first up, who's standing by with what we can expect from this earnings season. Varinder, the big question is whether we are going to see some hints of a revival this time around.
Well, thank you so much. The big question clearly is whether the earnings will revive in second quarter or not. Remember, first quarter earnings were hit. Nifty aggregate profitability was down by nearly 11%. And of course, the economy is battling with demonetisation, GST and RERA as well. So this time, analysts on the street are, hopeful that Deutsche Bank, of course, if I just can quote them, that the aggregate revenue for Nifty revenue could increase by 8%, EBITDA by nearly 13%, and profitability by nearly 17%. Even if these numbers are achieved, remember the first half earnings for Nifty will be up anywhere between 1 to 2%. So there's a lot to do even in the second half to achieve that double-digit mark, which the analysts expected at the start of this at the start of this financial year. So what could lead the rally? Clearly commodities. Commodities will be the one where we'll see huge, upsurge in terms of numbers because of the low base. Energy is the one to watch out for. Metals, they have been strong all throughout, so watch out for that as well. And the private financials are the one. The numbers will come on your screen. How much growth in terms of revenue, EBITDA and profitability it could come. The sectors which could lag are clearly telecom and pharma. Watch out for them. They could be the one which could see more pain, especially telecom in this quarter.
Okay. Well, thanks a lot for that overview, Varinder. In a bit, our entire research team will join us, with each of them giving us one sector-specific earnings expectation. But before I go to our IT sector, let me get Sanjeev on this. Sanjeev, what are you working with as an earnings growth for the quarter and for the first half?
Yeah, hi. So Lata, we think this quarter, if you get away with something like 450 rupee earnings on the Nifty, it will be a very, very big surprise. I see low single digits. I don't see 7 or 8 being crossed. And we are aware of all the, headwinds which we have. Already you've had 2 companies which are large bellwether, which have already warned. So that was HUL on the consumption side and L&T on the capex side, which was telling you that this quarter is maybe a washout for some of them. There will be some bright spots, like you mentioned, metals, commodities, oil and gas, and select autos and private banks. But more or less, I would expect 450 to be the target. And, this quarter could be quite a washout.
Okay, expect a washout quarter, says Sanjeev. Let's get in our other experts as well. Dhananjay, thanks for joining us on the show. Let's get your estimates in. Single digit, mid-single digit, high single digit, flat. Where does the number stand for Q2?
So for our universe, if you consider the non-bank and non-oil sector, the earnings growth that we are sort of looking at is close to 9.5%, a top line growth of something like 10.2%. EBITDA is growing at something close to 10%. Overall, if you look at it, there does appear to be a sort of a considerable skew in terms of sectors that are contributing, largely relating to metals and autos. So if you remove that, then I think the numbers are pretty modest. So it's a very skewed quarter. There is a sort of a modest decline in the margins. But it is still a mixed thing. We'll have to see whether going forward with the rise in commodity prices, will that translate into a sustainable earnings growth? And my hunch is that you might on the one side you have a sort of a demand stimulus led by larger government spending. You also would have a scenario where margins will be under pressure because of the increase in raw material prices. So I think in this quarter, since you have a dislocation relating to GST, an inventory built up, inventory run down, all those things have happened. So I don't think this quarter will necessarily replicate or sort of symbolize what will be the trend going forward.
Okay. Well, I'll come back to how disappointed the market will be if the numbers indeed turn out to be flat. But just a quick number from you, Anish, before we get to the sectors. What is the first half growth and what is the second half growth you're currently working with?
Yeah, so what we are looking at is an IDFC universe growth of about 9% for the whole year, which is about 3% growth for the first half and about 12% growth for the second half. But having said that, this quarter in particular, we will be seeing a 6% growth in Nifty estimates and about a 4% growth in the IDFC universe estimates. Now, having said this, it always masks, these aggregates always mask the outliers and always mask the performing and the non-performing stocks. So what I see is that all the asset-based industries, which we have been talking about for quite some time now, for the last 1.5 years, that asset-based stories are going to perform, and that's exactly what is also getting reflected in the numbers. So if you look at the commodity segment, which is an asset-heavy segment, is expected to report an extremely robust growth. About a 20% growth in earnings is what is expected from all the commodity-based sectors. So non-commodity-based sectors is something which is going to report declines in profits. So, what we are saying is that when you look at the 5.9% growth, actually the low PE companies are actually reporting better growth than the high PE companies, which means that if at all the market moves up, actually it's a PE re-rating which is happening and not in line with what we see as the earnings growth is. Okay. So from that perspective, when I look at it, then I find that you find that the commodity-based space is where you will see more upsides, and with the commodity prices staying firm, you will continue to see more upsides in the stocks also relating to this space.
Absolutely. 8% I think up move in average sort of price of oil when the quarter started to where we are. On that note, let's actually get down to individual sectors, and our colleague Anisha is now standing by to run us through the preview for the IT sector. Anisha, what will the biggies deliver?
Well, yes, TCS came in with an inline set of numbers with a dollar revenue growth of around 3.2% and a constant currency growth of 1.7%, something that the analysts are factoring in for the entire sector, as Kotak expects a constant currency growth quarter on quarter of anywhere between 1 to 2.5% for tier 1 companies. Yes, the cross-currency tailwinds were seen in TCS as well, but the headwinds that we saw in terms of BFS as well as retail is expected to stay for the entire sector. Now, Nomura, for example, expects Infosys to cut down the guidance when it comes to the revenue growth to 5.5 to 6.5%. But we have seen in case of TCS as well that they have not cut down their EBIT margin guidance. That has stayed at 26 to 28%, and that is expected to stay for Infosys as well. In terms of the margins, they are expected to be very company specific. Key thing to watch out will be Infosys, of course, because the new management is expected to come out with future strategy. Any further commentary on BFSI retail and the deal pipeline would be keenly watched out for. Back to you.
All right, thanks a lot for that, Anisha. Let me quickly get some expert comments on it. Sanjeev, what will you watch out for in the IT space? Which company?
So Lata, two names, HCL Tech and Tech Mahindra, which have always delivered in the last few quarters and which sounded very optimistic. And in the mid-cap space, a Mindtree. But as a value proposition at 900, as a disclosure, we've been positive on Infosys. We think you could get a 8 to 10% upside in the stock price. Maybe the results and the guidance could be muted.
Okay, Dhananjay, you want to comment on this? IT, considering the kind of move that we've seen, Infosys for that matter, I mean, there's a different tailwind of the buyback that's supporting that stock. But will there be anything material in terms of the business which can move the needle for the stock price?
So I think you have a sort of a turmoil that we have already seen, and that's past now. I think the management is trying to sort of resurrect the confidence and try to sort of communicate that there will be no impact on continuity of existing clients after Sikka's exit. My broader sense is that you might actually see a sort of a change and a certain level of dislocation that will happen from a strategy standpoint, and whatever thought process Sikka had, whether that will undergo a change. Whereas it is communicated that the continuity will be there, I have my doubts it will be there. So I think there will be uncertainty that will continue from Infosys standpoint. So we are somewhat sort of cautious on that. Clearly, the only tailwind that we see is this whole inducement by giving high dividend payouts and stuff. So I think those are temporary things. So I think investors will look beyond that, and I think people will look at structural issues, the management issues, and top level management guidance and future strategy. All these things will be very critically watched as far as Infosys results are concerned. So I think that's a very critical sort of stock to really watch. And our view is that you will have a mixed bag with respect to the IT sector results. You have a sort of a positive inducement or impulse coming from cross-currency tailwinds, whereas you also see a sort of you will also be looking at increase in wage costs. So there is a mixed thing with respect to the margins, but I think generally the margin pressures are going to be there. Our own sort of assessment with respect to longer-term strategy and also from a near-term result standpoint, there are 3 stocks that we have been positive on. Those includes L&T, Infotech, Mphasis, and TCS.
Okay. Got that. Thanks, Dhananjay. Very quickly, Anish, what is the one thing you will watch out for in the IT results? Will it be client orders? Will it be margins? What's the one parameter? Anish?
No, I think very clearly, if you look at the street is extremely... can you hear me?
Yes, please go ahead.
The street is extremely negative on the IT pack. The street is extremely negative to cautious on the IT pack. So even a small surprise there could mean lots for the stock. Like for example, Infosys, where I think most of the analysts would be guiding for either no growth to a very, very small growth scenario in profit. And if they are able to show something in a particular quarter, then probably you'll see an upside in the stock. So I think as far as IT goes, I think there are 2 or 3 stocks which I would like to focus on. One is Tech Mahindra, and the second one is Mphasis. I think these are stories which we feel are good for next 2 years, and they will continue to report better performance as we go forward. I think in terms of the large caps, we are seeing very erratic performance come through every quarter, except for HCL Tech, where we have seen a stronger performance come through.
Taking a break, and we are coming back. When we return, we are going to tell you what to expect from banks, metals, auto, FMCG. So stay right there, tuned into Quarter Se Quarter Tak.
The rundown that really brings you up to speed with what to expect from corporate India in the second quarter. Well, let's actually move to another sector where numbers, at least in the month gone by, the September numbers have been looking very, very good. I'm talking about the auto sector. Now, can this translate into some very solid revenue and EPS growth? Let's get in our colleague Naveen. He has the lowdown for us. Naveen.
Well, things are expected to be better for the auto sector in the Q2 of FY18 as compared to Q1. Passenger vehicles over there, Maruti is one which will be leading the growth with a revenue growth of almost more than 20%. On the other hand, the overall margins will be aided by positive leverage kicking in both because of volume increase as well as realizations improving. In the commercial vehicle space, Ashok Leyland is where the growth will be seen, expected to grow more than 30%. Also remember, the CV segment will be growing due to 2 reasons. One, the higher tonnage as well as the increase in freight rates in this quarter itself. Two-wheeler segment, Eicher, that is where the consistency will be seen. The growth is expected to be more than 30%, both in terms of margins as well as revenues. Also, Hero is one company which is going ahead of the industry in terms of the two-wheeler space. Also, Bajaj, there is seem to be some turnaround expected on the back of higher volumes. Back to you.
Fair enough, Naveen. Anish, to come to you for the expert comment, we already know the numbers, the sales numbers. What will you watch out for, and for which companies?
So I think the companies which probably don't report numbers are the ones which one should watch out for. So we probably would see a very strong growth coming in Motherson Sumi. We would see about a 50% odd kind of profit growth. We would see a similar kind of a profit growth coming out of Bharat Forge. At the same time, the two-wheeler companies are the ones where two-wheeler companies and Tata Motors are the three companies where you will see very, very low growth. Like, for example, Hero MotoCorp will probably PAT growth would be around 5%. We are expecting Bajaj Auto to report decline in net profit, and so would Tata Motors. TVS would grow strongly at about 20.4% in PAT. However, having said that, what we see is that the last month, that's the month of September, has been great for a lot of auto companies. And that is something a lot of people would convert that into a trend, but probably you should not forget that Diwali for the last year and this year has been in different months, and to an extent there has been some preponement of sales and stocking with the dealers ahead of the Diwali season, more in September this year than in last year. So you saw a more robust growth on a YY basis. What we find is that we'll need to combine 2-3 months and see how the growth is going to be. At the same time, everything gets reflected into the quarterly numbers of this quarter and the next quarter. But in the auto space, Eicher clearly continues to steam ahead. Maruti continues to do very well. It has been gaining market share and continues to gain market share. It has large waiting periods for almost all its new models. So these two are really good stories to continue with. And the other two good stories is going to be Ashok Leyland, which is in the CV space and is gaining market share. It's improving its margins, and therefore, and also volume growth has been fairly decent. So Ashok Leyland and Motherson Sumi, these are the four very strong stories which we continue to recommend to investors.
All right, that's the auto sector. Let's move on to the next big one. It's really a big one. I'm talking about banking. Abhishek is joining in. I guess it'll be a very granular story of the good, bad, and the ugly. Abhishek, run us through the overall theme.
Loan growth has picked up in the last 2 months, but however, they are expected to remain in lower single digits. Slippages trend is expected to remain downwards and therefore aiding in provisions being lower for PSU banks and aiding in their earnings momentum. However, elevated provisions for private sector banks can be seen, and therefore earnings impact over there will be felt. Bankers' comments with respect to the 40 new additions to the IBC by RBI will be seen very closely with respect to its impact on the balance sheet.
Fair point, Abhishek. South Indian Bank has already told us that, slippages could be under control, but provisions will go haywire. Sanjeev, what will you watch out for? Can there be pleasant surprises with the corporate lenders?
Well, difficult. If you saw what the numbers from South Indian Bank was, they were quite dismal in the sense that NIMs and net interest income may have gone up, but the provisioning part was really very difficult. And I think that will be the cornerstone for some of the PSU banks and namely ICICI and Axis, which are the major corporate lenders. It will be the retail guys which will be laughing their way to the bank as NIMs expand, and we think asset quality will be under control. So these will be the 2-3 key points. The other thing would be that given that the last base effect of AQR, maybe you get some sort of treasury income which could escalate for the likes of State Bank and Bank of Baroda.
Okay. Yeah, a little bit of treasury income, and I think by October 1st, the yields had started rising. So banks just escaped by the skin of their teeth. Nigel, let's get you in here. What are you expecting from the metal space? Commodities, all our experts were saying, will have a good quarter.
Well, expect a very, very good quarter coming in from the metal stocks. Why? Because LME prices of all base metals are up between 25 to around 30%. Even for the ferrous stocks, I've seen that steel prices are up more than 21 to around 23% on a year-on-year basis. What can play spoilsport then? For the ferrous stocks, well, iron ore prices have spiked up. Coking coal costs as well have gone up. So that's what will hurt them. And in terms of aluminium players, what's going to hurt them? That coal prices have spiked up, and also caustic soda prices have come in higher. In terms of iron ore as well as coking coal, Tata Steel and SAIL, they're partly protected. JSW Steel, though, they're not integrated at all. So they'll get hurt harder. Though on a sequential basis, we're expecting the EBITDA per ton to expand. Watch out for Tata Steel in particular. Volumes are likely to come in higher because of the expansion at Kalinganagar. We have demand as well that's looking quite good, and European operations have been looking steady.
All right, thanks, Nigel, so much for that. Dhananjay, so, I mean, what does this mean in terms of the EBITDA or EBITDA per ton metric, which a lot of companies look at? Because as Nigel is explaining, even input prices are rising for metal companies.
So if you look at the thing is that the realization price, realization for the metal space, especially for the steel manufacturer, is likely to be much higher. You had some impact of the input cost, but I think by and large the margins are going to expand. So if you look at it, for the overall metal space for our universe, the revenue growth is roughly about 26%, and the operating profit growth is almost like 66%, and the PAT growth is almost like a huge 150%. So there is an increase in volume. There is, especially for the steel sector, increase in realization, etc. I think all those things will actually feed into the entire sector.
Is all this in the price, or are we likely to have upside surprises in metals?
So I think we are going to have an upside surprise from a metal cycle standpoint. We think that globally there is an uptrend as far as metal prices are concerned, with stronger numbers that are coming from a macro standpoint from advanced economies. There is some concern on China, but by and large there is an upturn globally. So I think from a global metal prices, even now with respect to steel, I think there is an upside with respect to metal prices, and there is a certain supply constraint that is actually being put in place within China, and there is a sort of infrastructure demand that is also there in China. So I think that is going to span over several years. So there is a sort of a general trend of an upside with respect to metal prices. So I think we had gone a little bit overweight on metal stocks even last year. That trend seemed to be evolving. So I think that trend is going to will continue. And I think this quarter you have a phenomenal expansion as far as profit growth is concerned. So that continues, and we did a sort of a plant visit in Tata Steel in Jamshedpur last week, and I think we came back very positive in terms of the plant capacity utilization, the Kalinganagar plant ramp up, and the way the management is looking at the future. So clearly they are looking at a better demand scenario going forward.
Analysts are expecting the energy sector to see good numbers. Varinder, back with us. What all should we watch out for, Varinder?
Well, thank you so much. This time energy sector is expected to deliver a really strong set of numbers, clearly because of the underlying. Crude was up by nearly 2% quarter-on-quarter. And importantly, Singapore refining margins were up by nearly 30% on a sequential basis. The important number is that the Reliance Industries reported its number. Strong set of numbers, but it is more led by Jio, which reported EBIT and EBITDA positive for the first time when they reported numbers this time. And of course, the petchem segment was very, very strong. But the refining was not as strong. It actually disappointed in terms of what investors are expecting. For all other OMCs, whether it's HPCL, BPCL, ONGC, people are expecting strong set of refining margins coming in. The GRMs for most of these companies are expected to be over $9 per barrel. So let's see, whether that disappointment from Reliance Industries drag, OMCs or not. That is the big question which everyone will wonder after the Reliance results coming in. Otherwise, gas, whether it's GAIL or Petronet, LNG, stable set of earnings report expected from there. IGL, again, the volume has been always great since last many quarters. Even this time, the volume is expected to be higher by nearly 3 to 4%, and also the EBITDA per SCM, so no complaints over there. Keep an eye on ONGC, Oil India, they do nothing in terms of results, but since oil has been moving up, so they may report good numbers on a sequential basis.
Okay, that could be the kingmaker sector, right? And that's exactly what all our experts seem to be in agreement on. Oil and gas is going to be the watch point. So, Sanjeev, let me actually come back to you. As Varinder was also pointing out, stocks have already run up. I mean, many of them are close to their 52-week highs. So, where is it that you're expecting the best of oil and gas earnings? And therefore, what could be the most interesting stock to play?
Yeah, so the upstream companies, ONGC and Oil India, we have been very, very positive. ONGC at 160 and Oil India close to 325. They've moved up about 10 to 12%, but we still think there's a 20% upside in both those stocks. Surabhi, the dark horse again will be the gas utilities. They've been in a very, very sweet spot in the last 3-4 quarters, and all three, whether it's GAIL or IGL or Petronet LNG, I think price and volume both will be very, very favorable. On the OMCs, I think this time there could be some gains on the IGL or Petronet LNG. I think price and volume both will be very, very favorable. On the OMCs, I think this time there could be some gains on the inventory side. So HPCL and IOC could be dark horses which can outperform over there.
Let's quickly move to yet another big sector. We're talking about the FMCG czars on the street after GST. Can they show normalcy this time around? Mangalam is here to tell us what the numbers might throw up.
The second quarter of this fiscal is all going to be about restocking after the first quarter was about destocking. Also, the festive season, that one's come into this quarter as against the previous year, so that one would spur some sort of demand. It'll be more prudent actually for FMCG companies to look at volume growth in the first half and compare them to the previous year's first half. The second half, of course, will have the base impact coming in from demonetization, so likely to improve much more. But as far as this quarter is concerned, industry checks suggest some weakness in the rural as well as the wholesale markets. ITC volumes expected to decline 3% given the GST weakness. Asian Paints seasonally weak quarter for paint companies, flat volumes there, mid-single digits for HUL, Colgate and the likes, and high single to double digits for Imami and the others.
Okay, thank you very much for that summary, Mangalam. Sanjeev, which FMCG will you back? Will FMCG live up to expectation?
Yeah, so you will have to look beyond this quarter because we've already seen the likes of Lever tell us that rural demand is not picking up and volumes and margins could be under pressure. You know the reasons, and I think the GST disruption will play a big role. On a price performance, we think the risk reward for an ITC is extremely lucrative. So is the case with a Marico, which could be an outperformer. Asian Paints will also get hit because of the rise in crude prices, which could be an input cost. But Lata, just a little bit sideline from that would be the beverage market. Tata Global and Nestle. These, if you stroke them in the FMCG basket, they would be relative outperformers given the advent of coffee, Starbucks, and that whole chain picking up. We think Tata Global, Nestle are two outperformers. As a recommendation, we've had a buy call on them since last 6-9 months, and as a disclosure, we have positions in them.
Oh yes, Tata Global, Jubilant, Manpasand, Britannia, all of them have already risen about 70% year to date. So can they surprise and continue to command the price that they have will be the question. Let's take a break on that note. We are going to come back with a couple of more important sectors in a minute. Pharma, NBFCs, cement and power. All that in a minute. The show where we analyze and prepare you for the coming earnings season. With us are Sanjeev Bhasin of IIFL, Anish Tamania of IDFC and Dhananjay Sinha of MK. Let's first get our own expert. We're going to discuss pharma and inevitably Ekta to tell us what to expect. Ekta.
Well, it's expected to be a Q-on-Q recovery for the India business, but overall, US is expected to still be pressured for pharmaceutical companies this quarter. Sun Pharma, Lupin, US markets still expected to be pressured because of lack of significant launches. Dr. Reddy's may see a sequential growth in terms of the US business due to a launch of Doxil generic. Aurobindo and Cadila should do well because Renvela generic for Aurobindo, the kidney drug, should contribute to US, and Lialda generic, the ulcerative colitis drug for Cadila, should contribute for their US business overall. For two companies, specifically when it comes to US FDA, that's going to dominate. For Biocon, commentary with regards to the Bangalore plant will be top of mind along with the biosimilar portfolio. And for Divi's, the recent US FDA remediation and reinspection will again be top of mind, and the impact on earnings will be watched out for.
All right, thanks so much for that, Ekta. Sanjeev, we've seen with pharma, that's really not about the sector, it's about individual companies. So let me ask you in company terms, the high flyers that might show that there's a bottom in place and the ones that will still struggle.
Yeah, so it's going to be a mixed bag. It means that results may not be up to what the market is making or maybe muted. But the price performance of those stocks has already bottomed out. And you want to take 5 large caps, Dr. Reddy's, Sun, Lupin, Divi's Lab and Pfizer. These are 5 where we've been doing a SIP in the last 3 months, all on the back that the worst of generic pricing may be over, and FDA approvals now in the last 1.5 months have been the best ever since the last 18 months, which is telling you that the new launches and the new approvals which they get will have a lag effect of being launched in the next few quarters, and that will be when money comes on the table. So the timing may not be so easy, but we think most of the negative issues have been done with. And for Sun, it will be the launch of specialty chemicals. For Dr. Reddy, the launch of new drugs, which has been a very, very strong positive. And for Lupin, it will be the cut in R&D and further growth on their existing new launches. And we think that that could be a turning point. So for us, this has been a SIP which we've recommended in the last 3 months. And we continue to invest and recommend that do a SIP in pharma, because they will also be a conduit for the rupee, which will now become a tailwind if it tends to depreciate from here.
Sanjeev, that was a great summary of all the key stocks that we should watch out for and what we should watch out for. Buy the distress is the advice that Sanjeev is giving us. With that, let's go over to the winning sector, as it were, for the last, 6 quarters, NBFC. Abhishek, back with us. What should we expect, Abhishek?
Strong momentum is expected for gold financing business, but Manappuram's profitability may take an impact due to MFI's provisions. Consumer and two-wheeler financing has remained strong, so expect strong set of numbers coming in from Bajaj Finance and Shriram City Union Finance. On the housing sector, the impact from intense competition on the lower rates coupled with RERA may be seen, and therefore loan growth can take an impact. On the MFI and small banks, expect higher provisions to dent into earnings of Ujjivan and Equitas, but Bharat Financial can report net profit after reporting 2 quarters of net losses. Coming on to vehicle financing, post the GST implementation, CV sales trend have been really strong, upward of 25%. Therefore, strong earning momentum expected for Cholamandalam and Shriram Transport. Back to you.
All right, Abhishek, thanks so much for summing that up for us. Dhananjay, let me come to you. Do you think that earnings will come through to justify those NBFC valuations, and which are your top picks?
So our top picks are Bajaj for the quarter. From a quarter standpoint, it is Bajaj Finserv, Edelweiss are 2 leaders that we have identified from a quarterly result standpoint, and the laggards are LIC Housing and Shriram City Union Finance. Overall, Chola Finance is so overall view that we have is that we need to really be focused on new niche consumer lenders, be away from housing finance companies. We believe that there will be intense margin pressure going forward. So from a valuation standpoint, we are somewhat circumspect for portion of the NBFC that will face more intense competition. I think from a quarter standpoint, I think it's going to be a mixed bag, wherein we are saying that if you look at those guys who are having large exposures in the SME space, those are the people who will sort of have a weaker quarter versus those that are actually directly lending, that are engaged in asset-backed lending, largely in the auto space. So I think that is the overall context that we are looking at. If you look at the MK universe, our universe of NBFCs, we are expecting an NII growth of 21%, largely led by Bajaj Finance and Edelweiss Finance. So these, as I said earlier, these are the 2 leaders that we are looking at. And the PAT growth is expected about 16%, but the drag over here will be LIC Housing and Magma Fincorp.
Okay. Well, take your point. The house is actually deeply divided on housing finance. There are some who believe margins will be under pressure, and there are others who believe that it will continue to be the safe sector. But when MK says that the rival Edelweiss is a great stock, that's really a large-hearted comment. Thank you, Dhananjay. Cement sector. Let's see what that will do in the second quarter. Nigel is here with us. Nigel?
Well, cement space is where, in fact, we've really been seeing the big hope trade play out. But the second half of the year is likely to look much better on a lower base. In the past quarter, though, what are we looking out for? For volumes, you're looking out for pricing. And the third factor you're looking out for is input costs have spiked up. which will hurt margins. In short, cost pressures are likely to offset higher volumes as well as any kind of pricing that we have seen. Demand as well was impacted because of heavy rainfall, scarcity of sand, and also we saw poor demand coming in from the housing segment. Though volumes will come in higher because ACC and Shree Cement, they expanded capacity. We had Ultratech and JP Cement coming together, so that as well will aid volumes on a year-on-year basis. And finally, Ambuja Cements will report volumes on a very, very low base. What plays spoilsport though is pet coke prices have spiked up, so that will hurt particularly Shree Cement.
Thanks for that, Nigel. Anish, all yours. Which ones would you back?
Yeah, so if you look at the cement pack, the only company which will report a growth in profits is going to be ACC. That's what our expectation is. Most of the companies are going to report declines, so sharp declines in net profit. I think you have to see this interesting phenomena. The first quarter was very strong in terms of both price growth, and it more than covered for the cost increases which we have. But ever since that first quarter, the second quarter has seen a sharp dip in realization, and cost pressures have remained elevated. So what you're going to see, not only would the volumes be lower than in the first quarter, in the second quarter, it's a seasonal trend, but also you will see sharp dips in EBITDA per ton. So you are going to see sharp, except for ACC, you're going to see sharp drop in EBITDA per ton and sharp declines in net profit. So cement, if you look at the performance of all the cement companies except for Ultratech, most of the cement companies have outperformed the market over the last 9 months, and I think we can see some of this outperformance taper away for a short period of time, given that these results could be a little weaker.
Okay, all right. So expecting moderate performance from the cement space. Let's move then to power and infrastructure. Anisha joins in. Anisha, that's like good news that we started getting in from power companies, better generation. Will that translate to numbers?
Well, yes, finally a bit of good news coming in for the power sector, as the generation has been strong, as we've been seeing in the core sector data as well. For the quarter, the growth was around 5% for generation. We have seen PLF improvement coming in for the likes of CSC, NTPC, etc. Even the merchant rates were higher this quarter, so maybe see some impacts on the likes of JSW Energy as well. In terms of capital goods, the ordering continues to be remaining weak this quarter as well. Remember, for power grid, it is sharply down. Even the execution was a bit slow on account of GST as well as the erratic monsoons. For LNT, the case in point being where we are expecting the revenue growth to come at around 7 to 9%. Even if you look at the consumer durable space, the pre-festive demand has been a lot lower than expectations. So clearly it seems like it is going to be a weak quarter for the industrials. Back to you.
Thanks a lot. That's quite a large number of companies, power, infrastructure. Sanjeev, any pick of the pack?
Yeah, so on declines, L&T, I think the net interest margins will be much lower, you could say 7 or 8%, and they've indicated that execution has been a problem because of GST and so on. But the problem is that this will be the only, this is the best caveat which you have to growth picking up and capex, expanding from the private side, which has been totally missing. So how long can you have government capex pick up? And we think L&T is the best conduit to play that. We also have an overweight on Siemens at this after this sharp correction, because we think power equipment and so on could be the other conduit. On the consumer durables, we think any decline in Voltas will be a very good buying opportunity, given that their Middle East businesses started to show a lot of traction, and that will offset the weakness which may play out because of GST locally.
Okay. Point taken, Sanjeev. Well, L&T did tell, say in the media that working capital expenses will go up because of GST.
Okay. In conversation with Sanjeev Bhasin as well as Dhananjay Sena, they're helping us, of course, traverse through what to expect from corporate earnings in Q2. Well, it has been turbulent times for the telecom space. Is that going to change at all? Ronit is here with the expectations. Ronit?
A dismal quarter for the telecom companies, especially Airtel and Idea, where the revenue should decline 1% and 6% respectively quarter on quarter. A couple of the reasons. The first is the GST effect, where the taxes have increased from 15 to 18% on them, which they haven't passed on to the consumers. So this should dent their profit. Second, Q2 is a very seasonal quarter for them, where especially in rural areas, where the number of minutes reduce, which will impact Idea. And third, finally, aggressive discounts should continue largely because of Reliance Jio, which will impact the average revenues per user. But expect a good quarter from Bharti Infratel, where the revenues are expected to grow around 10% quarter on quarter, largely due to a data rollout by telecom companies.
The Jio juggernaut. Let's quickly get Sonal in to tell us what to expect from realty media and liquor, and then we are getting to our guests. Sonal.
Well, I'll start with the real estate sector. Credit growth is expected to be slow this time around, mainly due to RERA and GST. Talking about DLF, the sales will be down at around 5%. EBITDA could take a big hit, around 1,000 basis points, and debt is supposed to be increasing by around 600 crores. Going to media, GST will be hitting the ad revenues again because the FMCG companies will be reducing their ad spends. Z Entertainment is expected to give a decline in the revenues by around 6% and EBITDA. However, overall margins will increase mainly because of the sale of the sports business. Going to liquor, not so high around this time for United Spirits. There will be an overall decline in the volumes at around 16%, giving 7% decline in the revenues. That is optically due to the move towards franchising that happened last quarter as well. However, EBITDA margins will improve basically due to the cost-cutting measures.
Oh, 16% volume decline for United Spirits. I don't see that when you travel around Mumbai. But anyway, that's for a later discussion. Let's get to both our guests. Dhananjay, these are the tail-ending sectors. I mean, telecom, realty. Let me ask you this. Are you picking the bottom on any of the stocks?
Not really. Actually, if you look at that telecom thing, I think it's a structural view. I think the intensity of competition is there. With respect to quarter, I think that effect of Reliance Jio is still there. The competitive pressure is very high, and we are also seeing seasonal decline in the data usage as well. So I think broadly we are looking at a scenario where there is a downward spiral for EBITDA margins in general. So for our universe, the EBITDA margin is estimated at 30.6%. That's a decline of almost like 150 basis point on a Q-on-Q basis. And so I think by and large we remain underweight on this sector.
Even if the P&L improves, the balance sheet is laden with debt, I can imagine. Very quickly, Sanjeev, Shobha's sales numbers kind of perked up the real estate space. Are you buying any of the distressed guys?
Well, yes, all three are under our coverage and we are very, very bullish on all three, even though we think that, namely Shobha, Godrej Property and DLF, we think that this quarter, because of RERA and slowdown in the economy, there could be a one-off. But going ahead, Lata, you've seen the wealth effect, you've seen stock markets do well, and we think a lower cost of borrowing will definitely kick in. So for us, Shobha is the best play on the conduit of the Bangalore market slowly. Godrej is a pan-India play where I think their lease and build execute has been one of the best models, and that stock has been an outperformer all the way from 290 where we first recommended it. And DLF now becomes a proxy to a reduction in debt, getting away with most of their annuity income, and now the promoters will be reducing their stakes, so the temporary embroglio will be over. But DLF will now become a much better conduit for return on equity going forward. So all these three on declines or at present prices are buys from our side.